Good evening and welcome, my fellow Irish, to the Library of Mistakes, to this sellout event this evening. You're going to be hearing very little from me, simply to say that drinks are at the back. They are sponsored by Kennox Asset Management. Lauren is at the back as well and can take any donations if you want to donate to Didasco, which is the charity which runs the Library of Mistakes, and many other things I think you're familiar with. One new addition to the library, fresh from the Bahamas, we've managed to reinstate our FTX beer mug, our tin of beer, the one that was either stolen or disposed of by an overzealous cleaner. So please don't be stealing it or disposing of it. But if you want to look at our FTX Disruptor IPA, brewed by pirates for pirates, it's been restored to its place of glory. So that's it from me. I'm going to hand over to the man who pays for the drinks, Charles Heenan, because Charles used to work with Angus. So he knows where all the bodies are buried, and he's going to ask him about that this evening. Charles is Kennox Asset Management, and he will be interviewing Angus. Charles, over to you.
Thank you very much, Russell. Can you hear me? Angus, is your microphone on?
Is my microphone on?
No. Let's start with that.
You keep talking.
I'll keep talking. You sort that out. Very good. Thank you very much for all of you coming along. This is one of the few chances that I get to speak, as opposed to the keeper. So I do want to say, a couple of thoughts, big picture thoughts to set the tone for this evening. First of all, that I think investment matters enormously. I think it matters to companies, and therefore down the whole chain, to their clients, to the suppliers, to the customers, employees, all the other stakeholders. They matter to innovation. A lot of the innovation in our economy comes from there. The efficiency in our economy comes from companies. And then you just get onto it as an asset class, as a stock and something to play with in the markets. But it matters for one of the greatest forms of passing wealth from one generation to the other, for holding onto wealth for very long periods of time or investment. So I think it matters to all of us. But we need real diversity of opinion. It can't, we need a variety of independent, sensible outlooks. We need to have a range of investors willing to stick through the good times and the bad times. I think this is what makes a strong market. Another way of putting it, blindly following the herd is incredibly dangerous to the system as well as to your savings. So tonight, that just as context, tonight we're talking to Angus, who everyone will generally agree is one of the more original and gifted investors that have come around. Someone who is very good at calling out the herd, someone who is very good at taking a stand against the herd, and he was always exceptional at finding the unappreciated perspectives and the undiscovered angle. So this is going to be insights into the guidelines, into one way of investing, but one that has been proven to be very, very valid, some of the bigger issues. Now, Angus and I talked at length before this. Please, there's one there, there's one there. Oh, there's one over here. We talked at length around this, and one thing that everyone will say about Angus is he's one of the most original thinkers, which means that he goes everywhere. And we have lists after lists after lists of different things. So we're going to dip into some of those lists, some of the big issues, pull out some of the key points. And then leave it open for questions. Angus will be around afterwards for drinks. So anything you want to follow up on, we'll go from there. A bit of an introduction to Angus. He's best known for leading the team that built a $50 billion franchise, mostly in Asia, in Asia and emerging markets. They were award-winning, and they started from nothing, so very interesting. I think it is worth knowing that Angus is also a failed accountant. He never qualified as an accountant, having spent many years trying. He decided he had better things to do with his time. He worked for a national bus company, and the keeper was kind enough to point it out, says, "Don't get him on to talking about buses, you'll be there all day." Very enthusiastic about bus companies still. He worked for a farmers cooperative. He was then a stockbroker down in London and out in Hong Kong. And only then did he become a fund manager here in Scotland and start on that path to build a team. For those of you who are in the industry, so those of you who aren't in the industry, it is interesting to note that this is not someone who got straight A's from the best school and went straight to the best university and became a fund manager on day one. You can end up in down different paths and end up in the industry and become as famous as our esteemed guest, Angus. 2 seconds on the investment style. He always knew, one thing about Angus, always very clear what he believed in how investments should be run. And that is important, very important in this industry, that can drag you down many, many different directions. He believed in quality, as he defined it. He backed individuals. He rated cultures. He was a huge emphasis on the culture of a company. He didn't get carried away too much in bull and momentum markets. He held many stocks for decades, but equally he was very happy to be nimble, as you would call it, riding the tiger. He said, there's nothing wrong with riding the tiger, just be aware that you're riding a tiger. So he did all that. Angus is very keen on charities. It's an area we probably won't touch on this evening. He's started several and is very keen on the idea of giving back to the industry and the society. And you can chase him up after that, afterwards. So with that as an introduction, I will start with some questions. Very good. Angus, welcome.
Charles, good evening.
Listen, Angus, we were chatting. We were saying how we were best to start this. I said, for the perspective of the room, Angus started investing in the 1970s, or is in the industry in the 1970s. So let's have a little chat about what has changed since when you started. Maybe I would start on. It was interesting. We had said, listen, some of the biggest economies in the world: China, India, Indonesia, South Korea, Taiwan. None of them were in the index. None of them were investable. So it was a different world, even in Asia. We also, one of the ones that I think is fascinating, post and telex were the way people communicated back then. That then moved on to faxes. That's the big innovation. And now, of course, email and text and electronic. I would highlight, you had a list, Angus, of which I'll happily read you some. But I'd ask one or two on, one of the things you wrote down is the quantity of info has exploded, but the quality of information provided in its analysis has not.
Yeah.
So give us a couple of thoughts on that.
Well, I think it's very self-evident. Anyone in the business now is inundated with information. When I started, the way you made investment decisions, or just before I started, was you would get into the office at 10 in the morning, you would sit round the table, you would open the Post, and someone would say, Casanova done a good write-up of Jardine Matheson, yeah, what about it? And, someone might say, well, why do they like it? And they might say, well, maybe something's going on in Asia. I think that's a great idea. And that was the decision made. Things have moved on a little bit from then.
Anything to say about how you choose what matters in our current world of inundation of information?
Well, I was very lucky in many ways, but in particular having a father who was a fund manager. And I learned an awful lot from him. And I trying to think some of the lessons that he taught me, and perhaps the biggest one was to back people. It was all about people, and good people tend to gravitate to good business models, and good people generally don't over-borrow. And those are the three things in the model that we probably look at. But I think the emphasis he always had was in good people.
Come back. I'll drag you back onto what it was like back then versus now. Yeah. The world had more rules now rather than reputation bound. The world is more rule bound rather than reputation bound. Talk us through the advantages and disadvantages of both.
Well, I think perhaps when I started my career, if you used a broker and you would use a broker and you paid a huge amount to use a broker, probably the levels of commission would be 5 to 10 times as high as what an institution would pay now. But what you were really paying for was the information that he had that other people didn't have. And that information usually came from the company direct, and it's now known as insider trading. But it was what it was all about. I started as a broker, and I worked for Casanova, and they had very good corporate contacts, which obviously helped. And you go to a meeting, you go through each division, you would ask very short term, as it too often is now, but you would ask how well each division was going, and you do your sums as you were going through, and you'd realize that they were going to make 30% less than what the market thought. So you would then come out of the meeting, you'd find a payphone, and you'd ring your 3 biggest clients, and you get a pat on the back from the firm, and that's how it went. So in the sense that I think it's a much accessibility to information like that because of regulation is now much less. On the other hand, I think an awful lot of compliance is very much box ticking now, and it's not about the spirit. And I think perhaps, and I think people my generation tend to talk about standards declining when they get to sort of my age, but I don't think individual standards have declined. I think what's declined in the industry is the structure, the corporate structures. And if you had partnerships, as I worked for, well, first a partnership at Casanova and then at Stuart Ivory, which was really a partnership in corporate form, you were very, very careful about who your partner was, because they could lose all your capital. And you were very careful about how they behaved, and what really mattered was the reputation of the firm. And I think because the corporate structure now is much larger companies, people don't know each other so well, that it's much easier for people to get carried away. And you've seen it. And one example would be Goldman Sachs, which used to be a partnership, and I think had quite a good record, and then it ceased to be a partnership. And I think some of the things that Goldman Sachs has been involved with since probably wouldn't have happened if it still had a partnership structure.
On investment philosophy, you had a couple of key points. One, you said invest like it's your own money, and I think that is one of the, it's one of the fascinating issues out there is, how do we align the managers with the clients? I thought the second one, though, invest it like it's your own money. That how do we align clients and managers together? Preserve is as important as grow. It's an interesting point. Is that just a personal choice? Are you giving investment advice, saying don't take risk? Tell me you're thinking.
Well, it's probably just purely from. I think most people hate losing money, and I think sometimes we forget this in the industry. It becomes a game. It becomes part and parcel. It's all about doing better than the peer group, and I think if you look at the peer group. If you outperform the peer group, it's a desirable outcome. And a sort of educational analogy would be you don't go to school just to pass exams. You go to school to develop your capacity for learning and your interest in learning. And if you're taught well, you generally do well in exams. And I think with investment, if people start focusing on the peer group, particularly over the short term, or the index, and they use that as a sort of base to compete against, I think at the end of the day they start making decisions which are generally not in the long-term interests of the client.
Resist pressure to change when out of favor is another one that you wrote down. Talk about his personal experience and also, again, how it applies across the industry. And Angus, just before we go any further, I'm going to try and see if we can get you so that you get a little bit less. Let's try that. That sounds better.
Can you all hear me? Yeah.
No, we're just a bit scratchy.
Bad luck.
So resist pressure to change when out of favor.
I've always been very lucky, actually, in terms of the businesses, or for most of the time in which I've worked, and at Stuart Ivory, there was absolutely no pressure really to invest in any way at all. It was entirely up to yourself as to how you invested, and you were expected to look after the clients. You were expected to do fundamental research, know your companies, and behave properly. When you join a larger firm, and in the latter part of my career, we were owned by a bank, and banks tend to be very focused on asset gathering rather than investment performance. And it's not surprising because they're rewarded very much on how short-term earnings the company go. And so what I found was that when we started as part of First State, I had a very interesting interview. We had a new chief investment officer. He came up and he had myself and Stuart Paul, who was very much the sort of helped me, in fact, manage the business. And he had us into the office and we talked about the weather, what a great place Edinburgh was. Then he suddenly turned to me, he said, Angus, tell me, how long do you think you should give a fund manager before you fire him? And I sort of looked at him and thought, well, that's a very interesting question. I said, it depends. Are they sticking to their philosophy? Do they know their companies? Is there a particular fads in the market that means their style is sort of out of fashion, and so on, as it was in that time? And then we finished our conversation. I walked out and I turned to Stuart and I said, tell me, Stuart. Yes, I said, Stuart, I think I'm going to enjoy working with this individual. He seems to, be quite a thinker and be interested in sort of the industry. And Stuart just looked at me and said, Angus, I don't think you are. I think he might just have been talking about you. and I think he probably was. And fortunately, that was about 6 months before the tech market crashed, and which was a huge fervour at the time. We didn't have anything or very little money in technology because we thought it was all far too expensive. And so there was no question of firing me at the time. And I think that also shows that sort of actually having a lack of empathy, which I would say is sort of a personal disquality or failure, whatever it is, actually at times can help. You don't sort of worry. If you think what you're doing is the right thing, it sort of protects you a bit from common sense.
Fair enough, Angus. Picking up on something you just said, though, managing through the TMT bubble, is there, any thoughts on what, how it's like to invest in markets that boom and bust? I quite liked your story of Shell Malaysia, where the individuals were all quite distracted. But are there, things that apply to today, and also what you learned when you were going through it at the time?
Yeah. I suppose one of the things, you mentioned Shell Malaysia, and this was in the early 1980s, and emerging markets, when they open up, always overdo it. They go up to price-earnings ratios of 50, and there was one very big company that had a one-for-one bonus, and the share price, instead of halving the next day, stayed up for a whole week at the previous price, and before the sort of private investor sort of cottoned on. And anecdotal evidence in booms and busts, I think, is very important. I've always been better at identifying booms and being worried about the sort of herd instinct at the top of the boom than I have actually been catching the bottom of markets. And anecdotal evidence has been incredibly useful. The Shell Malaysia story was we went and visited Shell Malaysia, which was listed then, as a lot of companies in Asia were subsidiaries of British companies. And one of the things he told us was they'd done an analysis of all the calls going out of the office that week, and 70% from the office were from individual employees to their stockbrokers. And private sort of one feature of the Asian markets is the investors, the private client is a much bigger feature than the institution. So that was a sort of classic example. Malaysia at the time, you couldn't, if you had to book a phone call, you'd be on the phone for 3 hours before you were put through. So some poor person in the office had to make the phone call and hold the phone for 3 hours, and then eventually you got through to place an order. There were just dozens. You couldn't get into restaurants. Taxi drivers would start telling you what to invest in, and dozens of signs that show you when a market is really frothy. The tech boom was partly the same. There were two reasons. We read the cycle. I mean, obviously we sold our tech stocks probably far too early, but we read the cycle. One was a member of the team, Delegate, who noticed everyone was talking about one particular ratio at the time, and that was the PEG ratio, PE relative to the growth rate. And he said, why don't we look at different ratios and things like price to book and price to sales? And if you looked at them, they gave you a completely different picture in terms of valuation. And that really, if you're valued at 10 times book, as a lot of these tech manufacturing companies are, they're obviously going to raise as much money as they can, invest in new plant, and eventually the whole thing's going to collapse. But the other thing that warned us at the time that the market was very expensive was I went to a presentation given by a company called PCCW, which was sort of run by the son of a gentleman called Li Ka-shing, and it was very much flavour of the month. And as usual, I'm late for everything, and so I arrived. But not only couldn't I get standing room at the back of the presentation, I had to go and stand next to the stage and look at everybody. And just looking at everybody in their faces, I suddenly clicked that they had no better idea than I had, actually, about what this company was doing. They were just mesmerized. You could see it in their faces. And so that was a sign there that...
On the bottoms, you said you were better at the top than the bottom. When you're in despair and everyone's throwing things out, didn't find that as easy.
No, I think, and I've heard quite a lot of fund managers say this. I think it helps to be an optimist if you're a fund manager. It helps to be an optimist if you run a resource company as well. Then you've got to be particularly careful, because I don't think you can raise any money in a resource company unless you're very optimistic. But with fund management, it definitely helps, I think, to be on the optimistic side. And I think, and particularly, again, as one got older, one becomes a little bit too risk aware. You can never be too risk aware, but too risk averse. And certainly there were things that I did earlier in my career, some of which worked, some which didn't. But perhaps as one grew a bit older, one should listen a little bit more to younger people than I did. Seeing this as the library of mistakes.
I like it. Anything cycles now? Just I'll jump around. Yeah. Anything to say about markets now? Do they feel thematic? Are we at the bottom? Are we at the top? The top in certain markets and the bottom in everything else? One
thing I think I learned, or I hope I learned, but I don't think I did learn actually, and that's not to predict markets. You're on a riding to nothing, sort of predicting markets. I do think what we're seeing at the moment is this concentration of interest on a very small number of stocks is repeating or rhyming history, and there's too much this time. It's different, and I don't believe it's going to be different. And I saw the other day that I think in 1990, I think 7 out of the 10 largest companies by market cap in the world were Japanese. not one of those companies is in the top 20. And the music, I think, for a lot of these companies at some stage is going to stop, and it's going to be killed, I think, by regulation as much as anything. And you know, particularly with social media related companies, but I would just be very wary. And I was just thinking, actually, on the way down, that if I was looking to buy a fund at the moment, what I think I would do is get a list of all the funds out there, preferably investment trusts and discounts, and I would find out which had the biggest tracking error rather than the lowest tracking error, because I think we're in very much what we had in 2000 when you go to a meeting and all the consultants in particular would talk about was tracking error. And we didn't look at the index and we didn't know what tracking error was, but I do think it's something that one's got to be. There's too much tracking at the moment with the big companies, and that's going to end in tears. But it might not end in tears for 3-5 years.
That's the problem. The timing. We've barely started on my list, which means that we have no chance of getting through it. So I'll cherry pick some points. The business model. So you said there's 3 key things about your the way you thought about business: is business model, governance, and financials.
Yeah.
Business model, we all know that you're looking for barriers to entry, cost positioning, innovation, market share, products and services. What did you see that others didn't? Where did you find the opportunities when many people are looking for the same things?
I don't think it was in business models. I think it was more in
so then on to the next.
It was more into people. You meet someone, and if to me, the most important part of the job was company meetings, and the most enjoyable part. And I think what I was really looking for was, would I want to work for this company, and would I want to work for this particular person? And if the answer was yes, you were 50% there. Obviously, you wanted to be in a business model that was robust and had growth potential. But it was really backing the people, and if there was a sniff of anything dishonest, or even something that's quite honest but we didn't like. There was one company in India, Sun Pharma, that which eventually sort of collapsed through a fraud, and there was absolutely no inkling of this at all, but it paid a much lower rate of tax than everyone else. And that just made us uncomfortable. It wasn't a sort of, we think we should pay more tax. It was, we just thought they were just obviously cutting things as much as possible to the bone. And so we had to be a bit wary. The other reason we didn't like it was the CEO or the chairman and the finance director were brother-in-law, and they were related. And we always like to see 2 strong characters, if possible, in a business rather than just one. And what's great is when you have a meeting with a chairman and a CFO, and you see them actually disagreeing in a polite way and respectful way, but you see them disagreeing with each other. That to us is a real positive.
What I loved about working with Angus and trying to run an Angus interview is that you read through all the different lists and then you realize that it's not entirely consistent, because on your could have done better list, I noticed that you have fewer and better prepared meetings. So from a man who's just saying how important it was to see all sorts of companies, a man who is famous for going on a road trip, would have 6 or 7 meetings in a day and then not be happy, and he would organize a dinner and a breakfast as well.
But I would have got much more out of it if I'd rationed it, and probably saw fewer smaller companies. But the problem is that I think smaller companies are incredibly, you get an awful lot out of a smaller company meeting. They're much less polished. You can see an insight into an industry that you won't get from the bigger companies. So, whether it paid or not. Same with countries. I mean, I went on to places like Bhutan, Ecuador, Nepal, Burma, and places which, the markets have never really got established to extent that foreigners could go into them. But those markets, gave me a huge amount of pleasure meeting. I remember my chief executive, who's over here, James Ferguson. I took him to a trip to Sri Lanka, and he turned to me halfway during the visit and he said, "You do realise that the market cap of this country is half that of ICI." and the suggestion being that perhaps we're spending a little bit too much time, but it was a lot of fun.
Over lunch the other day, we were chatting about what we're going to talk about, and Angus said, "Oh yeah, I was on holiday in Sri Lanka the other day. Sophie let me off for 1 day to go." And this is recently in the last few. 1 day to go and see companies. Best day of holiday I've ever had. And he was absolutely genuine. There was no irony intended whatsoever. We always love the passion. Stock groupings and sectors, you had written down about them. You'd broken it out sort of steady and predictable versus cyclicals, holding and family controlled was one other grouping you had. I was interested to talk about those thoughts across that, but especially I thought it was interesting you had banks and TMT and tech companies and cyclical.
Right. I mean, I can talk about all of them, but not very knowledgeably. But banks, I think, as a sector, property was incredibly important, particularly in Asian markets and entrepreneur places, Hong Kong and Singapore. If the property market was heading south, then the banking sector was going to head south because the collateral and things like that. And I'm not sure I realised that, actually, until very late in the day. But, once the property turns, you don't want to be anywhere near a bank. The problem with banks is they're very often, and I think one of the failures or sort of things that aren't done right in our industries, people start from the top down. They say, gosh, we've got Asia's growing at X%, we've got to have more money there. And then they want to buy something liquid. So the obvious place to go for is a bank. And actually, if the economy is growing, if the currency is going in the right direction, which is terribly important, and the property market's going in the right direction, banks are probably a very good place to be. But the culture in the whole banking sector is that everyone has to. It's all again. We must outperform our competitors rather than do the right thing. So you find as the cycle goes on, invariably they go over the top lending to property or whatever else is the latest fad, and so as a sector, you've got to be particularly sort of focused on the economy and the stage of the economy.
And tech, is it as cyclical now, do you think?
I just said one last thing on banks. By far the best banks we found in the whole emerging market universe were family controlled. And that's because it's their own money. They don't want to lose it. And if you look at Singapore, OCBC, in the long run, when things went wrong, as a family-controlled bank or public bank in Malaysia, Thai Farmers Bank in Thailand, it was always the family bank that weathered the storm much better.
Okay, if you want to keep talking about banks, then I got one more for you.
Yeah,
when do you recapitalize a bank?
The other thing with the banking crisis, which I discovered to great loss at times, is don't go for the first recap and the cycle coming down. You should probably not go for the second, but the third is usually quite a good time to go for a bank. And that happened again and again.
Hopefully this isn't a skill we'll need to know anytime soon. Maybe 2 more seconds. Oh, well, do you want to do tech? Any thoughts on, is it less cyclical than it was? Or is it just as cyclical, just different ones?
See, my big fear when I was talking to clients was they'd ask me what a microchip did, because I could never really work it out. But again, company, an obvious company, and it's, I think, in everyone's portfolio now is TSMC, but it was the tech. You've got to see people that they're investing more than the competition, that it's being invested well, the cash. I love companies that grow dividends. Companies that don't grow dividends in the long run are possibly not really sort of interested in you as a shareholder. I love companies that don't have to raise money the whole time from outside shareholders. I love companies that generate growth themselves rather than actually having to acquire other companies, because it makes them very difficult to analyse. But, tech is obviously, it's rather like whatever you think of tech, you've got to keep an eye on it and a very close eye on it, and I'm sure it'll be a very profitable place. And I put China in exactly the same category, just in case you were going to ask me that question.
But maybe later, we'll run out of time. One of my favorite ones on the list, rule of law, period. Beware optimism. What does that mean? Beware optimism.
Rule of law. Oh, yeah, sorry. I think it was talking about resources. Two things. Resources, I always find that it's much better to invest in resources in fairly mature, developed countries where the rule of law are applied, because in an awful lot of country, assets in the ground are really seen by the government or certain members of the government as theirs rather than yours as shareholders. I think I find it very difficult. Gold was an example in what was it, Kyrgyzstan. The government, if resources are doing well, will always try and they're trying to do it in the UK at the moment, but they'll always take a big slice out of it.
Yeah, interesting. Portfolio construction process. One, there were many thoughts on that, but one that I thought was very interesting: team discussion, but one person final decision. Yeah. Talk to us about the role of the individual in the in fund management.
Yeah. Well, I don't think you can make investment decisions by committee, and you can't split portfolios up between two people, because a portfolio is a sort of analogy I've used in the past was like a herbaceous border. You want something to be flowering in different parts, at different times, and it's very difficult to have that if you have two people running one portfolio, and you've also got to have accountability. Is very important, and committees are fine when things are going well, but immediately things fall apart. People say, well, I didn't really like that. No one takes responsibility. It's much better that one person makes the final decision. I think you have to have someone else on the portfolio who has to be made aware and consulted before the decision is made, so they know why the decision is made. And I think you have to have a flat structure so that everybody in the team, whatever their status, sort of can contribute to it, or feels they can contribute to it. But at the end of the day, you've got to have one person making the decision.
Excellent. Mistakes, you have a list of them, things you could have done better. We've talked about a few: less time in smaller markets, the joys of small Sri Lanka. Less time talking to clients. We might come back to that one later on. Less time on valuations, I thought was interesting. Better avoid anchoring. I thought that was. Can you talk a little bit about that?
I think most people who've worked in our industry will own up to anchoring far too much, looking at what you paid for a stock and taking that into account when you decide whether to sell it. And thinking it's not just sort of trimming the winners, which I think people generally do far too early, and I certainly did. But it's also when you build a portfolio and someone gives you more money, and you have a 10% flowing in, you add it to the stocks that haven't performed so well, and don't add it to the ones that have performed well. And actually, you should actually, I think, remove book costs from portfolios. And the problem is, I tried that, and I made everyone remove book costs from the portfolio, but I found myself printing the valuations out with book costs on when no one was looking. which brings me on to another thing, a mistake, which is, far too much of do as I say and not as I do.
Anything else on mistakes? More acknowledgement of long-standing clients?
Yeah, I tried to sort of look at the mistakes, sort of business-wise. The biggest thing that I got right was, particularly in the post-Stuart Ivory days, was recognizing what I was hopeless at. A hopeless man-manager, hopeless at running a team, and
an excellent public speaker, though.
Well, no, hopeless public speaker as well, and I think if we go through life and recognise what we're not good at and find someone who is good at doing that to compensate, it really is 1 + 1 = 5, and the success we had. You mentioned figures earlier, but I think to a large extent was because I wasn't sort of running the business, because it would have been a disaster if I had been. And I don't think fund managers generally make good business managers.
I would also say one thing about you, Angus, is that you were willing to share. You didn't want to retain all of the winnings for yourself. So you were willing to delegate different roles, but then you were also willing to delegate the rewards. And in the long term, as we've all seen, it worked out amazingly well. But that one went very well.
Charles did once actually say to a client on this. He did.
Journalist. Which story about to tell?
No. You did say that you were asked, what kept you at I think it was Stuart Ivory at the time. And you said, I just love my job so much, I'd stay here if I was paid half what I'm being paid.
Which was I believe is exactly what I should have said. What did wind me up was when Angus quoted that back at me in the next meeting. It's like, shoot, I should never have said
that. Anyway.
No, it was. But no, there is something about doing it for the passion and enjoyment of it. And if you try and squeeze the pips out of it too much, then you're better off working with people you like. Talking about clients. Owning up to mistakes was one of the first things you'd written when you were talking to clients.
Yeah. This came from, I had a couple of mentors. One of them was someone called Lord Farington at Casanova, and he used to take me along to meetings, and we'd have a bad quarter, and he was absolutely brilliant. He'd go in with a very long face, and he'd look round the room, and he'd say, let's start with the howlers. And he'd go through the portfolio and he'd pick out the 3 worst performing stocks. And you could see the trustees just tearing their papers up like that, And then he'd say, but we did have a piece of luck. It was never sort of, his ability. It was a piece of luck. And, he mentioned as a company that had, sort of done rather well. And at the end of the meeting, he'd have a lousy quarter. You'd see people going up to him, patting him on the shoulder and saying, don't worry, Charles, we all have a bad quarter. And I do think that there's a thing in the industry that you go in and people, and I've had it, being on the other side sometimes, and you say, we're very pleased with ourselves, the market's down 20% and we're only down 10%. Well, actually, as a trustee of a pension fund or a charity, you don't care a hang as to well, you do, you like to outperform and everything, but it's the losing the money you want to sort of focus on when you're talking and own up to it. And clients will forgive you, a huge amount if you do.
The short-term business commercial versus long-term investment interest, we're back to the agency problem, aligning the two, but anything you want to add?
Well, 2 things there. I mean, I think we were quite good at it in the sense that we did close funds. And businesses ought to close funds, when they grow and they're finding they can't buy smaller companies in it and so on. They should close them, much earlier than we did. And we did, insist. In fact, I think we lost two senior people on the commercial side when we closed down the Asia Pacific fund because they just didn't see that we could open a leaders fund and it would grow in time.
Sorry, to be clear there, you didn't close down the fund. You closed the fund. You didn't accept any new inflows.
Yeah, we didn't accept any new business.
Giving the money back would have been a different. That would have been a different one. Yeah.
And people give you hell when you date, particularly if you've got a certain amount of clients and you have to sort of buy the same thing for any new clients, and you can't because the money's at the fund's closed. But actually, they respect you for doing that, and they might sort of be rather rude to you for the next 6 months, but they're really very pleased that you've done it because they know you're looking after their interests. So that's one thing. I was thinking whether we'd been too greedy during, and the answer is, I think everyone knows that particularly if you're successful sort of gathering in money, that because of this scalability, operational leverage, it's a very good business to be in. And what I wonder, and I should have done something about when I was in the industry, is whether people shouldn't give loyalty discounts. If you're in a fund for 3 years, why shouldn't you get a discounted fee after that? It would seem to me to be a very obvious thing.
Knowing when to break your own rules. I always thought that was interesting. More of a guideline as opposed to a rule. You had a very clear idea what you're doing, but then you would also do things that were against that at times.
Yeah.
Any thoughts?
Well, just that you shouldn't pretend you're not doing something that's not against the philosophy or the guidelines or something. Be open about it. I'm trying to think of some examples. Did I give you an example?
Well, you used to play IPO markets every now and again.
Yeah.
When I say play.
Oh, well, yeah. I mean, there was one share. We bought the first share we ever bought in Russia was in about 1992, and it was an electrical power company called UES, and we bought it because it was valued. The valuation of the company, if you did it per megawatt of capacity, was about 1/100th of what you would pay for the similar company in Europe. And we put 0.5% of the emerging market fund in. But it was pretty anathema to what we normally did at Stuart Ivory. And I remember actually going to the meeting and someone said to me, Angus, tell me, what do the financials look like of this company? And I had to admit that they hadn't produced accounts for the last 3 years. But it was only 0.5% of the fund. And we had actually, before the meeting happened, because I knew I'd be asked this question, before the actual meeting happened, we sold half of it, and it had doubled in the meantime. So I could say that, not that it's relevant, that the book cost was 0.
Which you didn't look at because you would have anchored on it.
Exactly.
The career advice, you've touched on some of these. You're very unlikely to be good at everything. Work with people who share your values. Build up as many networks as you can. Record and learn from your successes and mistakes. I quite liked your point. Those who stand for nothing fall for everything.
Well, I mean, that's David Gate, not me. It was his favourite quote, but it's very true. And it's interesting. I was having a chat with someone just before this meeting about ESG and the sort of governance and whether if you believe in ESG, and I think almost every long-term fund manager does believe, particularly in governance, but there's always going to be an imposition of your personal ethics on a portfolio, whether you like it or not. And so it's not a simple division of we can put our money there and run it as unethically, completely, and with your own money, sort of run it ethically or something. It's not as simple as that. So,
very good. And the last one, and we could talk about this one. What to change in the industry? Do you want to touch on one or two things, or should I read the list and then open it up to questions?
Well, what did we?
So focused on principle rather than detailed regulation.
Yeah.
The rules versus box ticking versus principle. Encourage longer-term investment horizons. One of the things you pointed out earlier on was give incentives to clients to give them better fees to stick with us. Less financial leverage.
Just on that one, this business of everyone being able to buy a share, and you have the same votes as you have someone who's owned the shares for 50 years, I think is ridiculous. I don't think you should be allowed to vote shares until you've held them for a year. I feel
Very
strong.
good.
Yeah, a short-term capital gains tax, I think would which they have in India, and I think would and it should apply to unit trusts and pension funds as well. I think that would make us all much longer term as well.
Less financial leverage, reduced investment banking influence, and more sensible remuneration incentives were your other ones.
Yeah. Well, IPOs, I mean, why aren't IPOs done by public auction? It's ridiculous. It gives a huge amount of power to investment banks. People give money to investment banks so they get a good allocation, and when it should be going to them for the research they're producing. And I don't understand. It becomes part and parcel. So it'd be much better if and it's been done. It was done with Telecom Malaysia when it came to the market. It was done by an IPO, and then people start focusing on what this business is really worth, rather than on what they can pass it on to someone else for, which is what investment's about.
We've managed to do 40 years and touch on every, a variety of points on the industry, but only touch on them. So in the interest of time, please dig into anyone that you think are interesting, and or over drinks afterwards. Who would like to? Question from the floor. Hamish. No, it's better for you.
Angus, you've obviously had a huge success, and the Far East has been the driving force of that. But obviously there are other areas that are emerging markets, the whole of Latin America, Africa, Middle East, etc. What sort of was the highest percentage you ever had invested in the non-Asian areas? In other words, was it 10 or was it 5 or whatever? In other words, did you ever feel there was a real justification?
I don't think. I mean, in our emerging market funds, there's no doubt, and I'd put this as one of my mistakes, I had a bias towards Asia. I mean, I think one's right to have a bias towards Asia, but I had a bias towards Asia. But I think we probably had 30 to 40% outside Asia. I would just point one thing is that the reason, you're quite right pointing out that I was incredibly lucky being in the right place at the right time, but it had nothing to do with me. It was because I couldn't get a job in Scotland, I couldn't get a job in London, but Cazenave needed someone in Hong Kong. And finding emerging markets, again, was pure fluke. I was down in New Zealand talking to forestry companies, and all they could talk about was their interest they just acquired in Chile. So I thought, well, and I'd got a very tolerant wife, and that's helped a huge amount. And I said I'd give her a plug. And, but I just rang up home. I don't think I even bothered to ring the office and said, look, instead of coming back from New Zealand to Scotland, I'm going to go over, leave her with the 4 kids, and went via Argentina and complete, no power and everything, arrived in Chile, and we bought 5% of the Chile fund on the back of it. And just one story. I then had to go to the bank and justify putting a Chilean investment in it was called the New Pacific Fund. So I remember going with an atlas to the bank, and I said, Tommy, who's got the longest coast in the Pacific? Of course, they said China, Australia, Indonesia, I said, actually, it's Chile. So I was allowed to, put some money into it.
There is an acronym for people who don't get a job in London and have to go to Hong Kong, isn't there?
Yes, I can't remember what it is.
Filth.
Everyone's been far too polite.
Field in London, try Hong Kong.
Oh, yes. Right.
Thank you. And good to hear you don't mind people being late. Really interested to hear what you say around culture. And you touched on the lens of would you like to work at that company yourself? But is there any other ways to effectively kind of measure an intangible, such as the culture? And over time, can the culture of companies change? How long does it take? would you have previously not invested in a company on culture and then invested in it at a later time on the culture having changed?
Yeah. It's different. I give you an example is Jardine Matheson. And in the late 1980s, they had a subsidiary, Mandarin Hotels, and they did a placement to the family, to Jardine Matheson, family-controlled company, which we as shareholders, it was a discount to asset value, discount to share price, but we weren't given a chance to participate. And that made me biased against Jardine Matheson for the next 20 years. Now, Jardine Matheson are very entrepreneurial, and well, they wouldn't be allowed to do that now, I don't think, and I'm sure they wouldn't want to do it. But you've just got to accept, I suppose, that some cultures are different, and there isn't a perfect one. But that was me putting the line shutter down and saying I much prefer Suarez, which wasn't so entrepreneurial, but much more scrupulous as a company, and played it more by the normal rules and things like that. And so I think one's always got to be prepared for change. But usually, you look at Boohoo in this country, usually you've got to change people at the top to change the culture. I think it's very difficult to change it otherwise.
You choose. You do, Russell.
Is China uninvestable?
No, is the answer. I mean, it's huge. I don't think it's uninvestable at all. I think if you invest in China, particularly in certain areas in China, you have to have quite a big risk premium, because the state, has a very big influence there. And what it does is quite unpredictable at times, and and most people would say the rule of law doesn't apply either. So if something goes wrong, your investment could be at risk, I suppose. But it's still certainly investable, and I'm sure people will do very well out of China.
Give us some of the positives about China over
Well,
your experience.
A very entrepreneurial spirit, very, very diligent people. Well, actually, you can't talk about demographics anymore, because actually they're not looking good. Even worse in South Korea now. Used to be a huge argument for China, but isn't anymore. But very low-cost producers, very determined. And in terms of certain technology like solar and things like that, they're leading the world, and their costs of production are much below anything that we can have in the West. Electric cars is another one.
You choose it, Russell. I'm happy.
Thank you. On a similar country-specific theme, using your expertise in identifying sort of booms and bubbles, what is your view on India currently?
Well, I don't have a current view, because I really am sort of up to touch with, where the market is. But we always had a lot more money in India than we did in China, because history was a very important part of what we did, and you had companies with long histories. In India, you had a much greater respect for private property in India as well. And equally, I think the demographics are certainly much better. And I think actually it's got an inherent sort of basis of democracy in India. People talk about it becoming too totalitarian and under President Modi, but actually I think the Indians are natural democrats, and I think it's going to be very difficult ever to make it a sort of dictatorship.
What advice would you give to newer investors or individuals who don't yet know enough to make rational and long-term focused decisions and are more tempted to short-term speculation?
Well, we had a thing called a conviction log for younger members of the team, and I'd encourage all firms to have conviction logs. And what it meant is that if they felt strongly about a sector or a company or anything, they had to write it down, put it in, and when they did their appraisal, they were allowed to bring it up, what it showed them actually, they bring it up and say, well, I thought we should be looking at Thai Pharma Bank and its prices doubled and everything. You get out the conviction log. It said, yes, but you also thought that we ought to buy this cement company, which is halved, and it's a very good sort of balancing thing. But it meant that people could register and learn from their mistakes, and I think learning from mistakes. One thing I really regret not having done is kept a diary, for 10 minutes every day or even every week, and just write what I've learned, what the biggest mistakes, what I've got right, what I've learned about the business, what I've learned about the particular companies. And I just think it makes the most wonderful reading if I'd done that now. And I'd really recommend that everyone does that.
Angus, you talked about overload of information, which perhaps is a symptom of growing mechanization in the economic system. Yeah. The usual suspects being growing passive investing, high-frequency trading, momentum CTA-type strategies, perhaps even monetary policies. Does this growing mechanization also reflected in concentration of the Magnificent Seven, etc.? Does that worry you in terms of price discovery and what it means for the economic system?
Well, I mean, I think it is a worry, yep. And it will unravel eventually. The problem is one doesn't know when. I mean, if you think about it, the more indexation we have, the easier it should be to be a successful active investor, because the absolute rubbish that the indexes are going to have to buy just to keep in line with the indexes, it beggars belief. So, when it changes, it'll be like a snowball going the other way. It'll unravel very fast, and I think active investors will have a great time. And that's why I would look for funds with really big tracking errors.
So I suppose it's in relation to the Magnificent Seven again, but you mentioned about parallels between the tech bubble previously. So do you believe that this may cause issues soon? And if so, what do you think the ripple effects are and how far may they reach if the bubble was to burst?
Well, I mean, I don't think it can add anything there. No, Charles, what do you think?
Pass. I'm not sure. I've gone. I do. I'm a bit like Angus. I do think that the concentration in certain areas is very dangerous. Equally, that should provide huge opportunities at some point. It's the timing of that and how far the system that is does seem very inclined towards pro-momentum. Yeah. How far that can push is very dangerous. But I quite like the analogy of the that shock period where I remember, Angus, I can't remember what period you were, but we were saying, listen, you were in the fourth quartile over all periods. We're probably edging on the fifth quartile, and this one over all periods, or we're looking really really tough. I think it was end of TMT, and then it turned so quickly because what falls go down 80%. What goes down up 50%. But that split suddenly is 6 times, and so things change very, very. When they change, they can change very, very quickly.
There are people in this audience who want to know what Yul Brynner's got to do with the stock market. So, any other questions? Yeah.
Over the course of your career, how you think about timing change? Do you think about it more or less as you went on And did you focus more or less just on buying good businesses and trying to pick the tops and bottoms, or did you get better at doing so?
Yeah. I don't think I got better at doing so. I think looking back, if I thought as much as I thought since I left, I could now come back and get it better. But I don't think I did when I was actually getting better. The more money you manage, the harder it is to sort of move in and out. And our turnover rate definitely declined. I think it used to be 70% in the early 1990s, and when I left, it was sort of probably 15 to 20%. But that was partly because actually I did learn a bit about letting your winners go, I think, and running it.
Presumably, if you'd kept this diary, then you probably would have learned a lot more.
I would have. The other thing, just as we're in the library of mistakes, which I think was very, very useful. I'm a great believer in offsites for companies, people getting away, sitting around a table, having dinner, possibly having a drink too many, and then sitting around a table and saying, right, what have you got wrong over the last year? And I don't know if you've ever tried it, but we did it quite a lot. And it will start with everyone going around saying, well, we didn't realize interest rates or something were going to go up, something totally extraneous to what they'd done. And then someone would come with another story. But each story, because fund managers are very competitive, people had to outdo each other with the story. And by the end, they were telling the most outrageous, well, I forgot to look the fact that this director, and thing. And they come out with it, and it's a bit like a sort of confessional. And they come out of it, and you would see, you go back into the office next day, and all these sort of laggards that have been allowed to sort of stay in the portfolio, they were cleared out. So I really think that's a fantastic discipline to have.
Yeah, I think we'll probably just have one last question.
You're the keeper.
What do you think about the structure of the industry with consolidation going on, and maybe in particular what's happening in fund management in Edinburgh?
Well, just looking around here, I would have thought fund management in Edinburgh was quite vibrant at the moment, and it's really encouraging. I don't think, if you had a sort of talk like this 30 years ago, I don't think we would have had an audience, like this. So I think from that point of view, it's really quite vibrant. I think boutiques somehow, I think small boutiques, and I think you can be a successful boutique within a bank quite easily as long as you have a robust enough agreement with the bank to make sure that you're in charge of the investment philosophy and so on. But there's no reason with modern communications that you can't run money here from Edinburgh as anywhere else, and long live the small operation. And if I was in charge of the Scottish government and pensions and things like that, I would say you've got to give a certain percentage of your business to small outfits based in Scotland. We find it very difficult to raise money in Scotland. Quite incredible, actually. I think we had one local authority client in Scotland. Far easier to raise money in the north of England and all over the world, but Scotland was very difficult.
For you. On behalf of the Keeper, thank you very much for attending, and can we all congratulate and thank Angus?
Thank you very much.